And if you're raising money for a deal, you got to be thinking about, how do I make sure I'm protecting my investors? Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer, and today I want to talk about what I've been seeing on social media. I actually got an email today and saw a post on social media about a deal just closed recently, and I just wanted to kind of talk through a couple things that have been on my mind, and mainly about passive income and syndications, and really what to look out for. So some red flags or things to really think through as you're looking at potential deals. And so the first thing is, I saw a deal that recently just closed, and it was purchased by an out-of-state investor, and it was a portfolio. One of the properties we underwrote, looked at, were very serious about trying to buy it. It was in a less than desirable location, but had been fully renovated. I know the area extremely well. I've owned properties in the area, so I know what to expect as far as the resident base and just kind of some of the difficulties around there. So I was comfortable with that. We underwrote the deal. The other portfolio we ended up not really going after because of the location, and just didn't like that. But the one we made an offer on, and we were really far off. We were roughly $100,000 a unit, right? And the building ended up selling for roughly $120,000 a unit, so significantly more. And as we looked back into our underwriting, I don't see a path to 120,000 a door. In fact, I think it's crazy to pay that much per door. I don't see profitability there. I do know the group that purchased it is doing a similar strategy to what we were looking at. You know, they're financing it similar. It's a syndication, so they don't have different money. So I'm not sure exactly what they're seeing, but that made me think, what the heck are they seeing? Why are they comfortable with buying this deal at $120,000 a door, when in reality, $100,000 a door, we were stretching to get to $100,000 a door? I would have been much more comfortable at $90,000 a door, than $100,000 a door. And there's nothing to do with this property, by the way. There's zero value add. Everything's been done. And the funny thing is, too, is the person that bought this, they posted about this portfolio, which again is in rough areas, C class, very much C class areas in a suburb that is not growing. And they posted how excited they were to buy this property in a great location, blah blah blah. So what do you do as a passive investor? Well, this is important as a passive investor to, obviously, first of all, know, like, and trust the sponsor. Trust that the sponsor is truly telling you the truth and they're being diligent about their underwriting. So I think that's first and foremost. That's going to go the longest ways. Do I trust this person? Do they have a good track record? Have they led me in a poor direction previously, or does it seem like they're buying deals that are, maybe they're pushing the boundaries a bit, and I'm not quite so sure. Secondly, understand the market as much as you can. Look, I get, as a passive investor, you're passively investing because you don't have the time and energy and maybe desire, all that kind of stuff, to be active. So you still want to take a passive role. So you don't want to spend a crazy amount of time on due diligence of the location. But I think it's understanding, where is this? If you understood that, it wouldn't take you very long to understand that this location is in a C-class neighborhood, yet the sponsor is telling me this is a great location. Wait a second, that doesn't add up. Why Are you thinking this is a great location when in fact it's not? There's high crime. It's just not a good location. Demographics show population's not growing. You know, that doesn't add up, right? That's a trust factor. I would say what's going on here. Um, Now the underwriting can be trickier because then really have to dive in and understand the numbers. But look for some of the basics. Okay, so first of all, you know, what is the actual income right now? And what is the projected income in year one? That shouldn't change a ton. It's really challenging to take a property that's making, let's call it $1 million a year in year one, or to the T12, what they're actually doing right now, and changing that to 1.3, 1.4 in your first year of ownership. It's just really challenging to happen. You should see very minimal growth in income, if any, quite frankly. A lot of times we see almost nothing. And then what is our rent increase after that? Are we going, 3, 4, 5, 6%, or are we doing like 1 to 3%? Okay. So if it's a market that's traditionally, look, that market traditionally, the Twin Cities is traditionally seeing about 2.5 to 3% rent growth. Okay, we're in that range. Fine. Well, how about our expense growth? Same type of thing. Are we seeing just, 3% rent growth and 2% expense growth? That's not going to happen, right? We want to see my expense growth has to be equal to or greater than my rent growth. That has to happen, right? There's nothing about that. Um, the other thing is rent increases. This can really skew a property. Is how aggressive is the sponsor being in rent increases, and ask for proof. Like, what? Why do you think you can get that? That's one thing that maybe this sponsor is doing. I'm not sure. I didn't see their underwriting, but maybe they're looking at properties that are not that far away, but are in a totally different location. So I can go, 5 miles away and I can get to locations that are, you know, beautiful. Like this property is beautiful property. So I can get to these locations, buildings that look kind of similar, and I can see rents that are really high because they're in a great neighborhood. Well, is that really the same neighborhood? Is that really a rent comp? And so how could you assume that you can get there, right? I've heard this. I heard this recently from another sponsor who's raising capital on deals consistently, and they tout their deals as B plus, and I've heard that most of their deals are actually in C minus to C plus locations, and they're using rent comps for these, BB plus. So just watch how the rent comps, do they really match up? Are they close by? Is there a railroad track between them? High freeway, and you can either easily do a quick search if you don't know the area, just to see the crime heat maps. It's really easy to find kind of the crime map. So we could go, okay, look, yeah, we look similar. Okay, then we can do a quick demographic search and we can go, okay, similar demographics, similar income in the neighborhood. Okay, we're good. And that's a quick way. I mean, if you really want to dig in, definitely better. But if we have similar incomes, similar demographics, some population growth, all that kind of stuff, we're probably okay. Same thing with property. Like, look, it's got to be a similar property. If we're using, if we've got like a garden style property, and we're using penthouse suites as our rent comp with huge units, and we got tiny micro units, that's not a rent comp. Same thing if I got townhome units that I'm using as my rent comp. We got our own garage, or 1,500 square foot 2 bedroom, and I've got 800 square foot 2 bedroom with no garage, no washer dryer, and you like totally different rent comps. So are we similar? Okay. So the next thing is, this one's tricky. Well, they're all a little bit tricky, but this one's a little trickier to figure out. And that's the cap rate reversion. Okay. So that's the cap rate upon sale. So what we want to look at is what is the cap rate today? It's crazy. There's a sponsor that put out on LinkedIn recently that he is actually underwriting cap rates to compress in 5 years when he sells. I think that's super irresponsible. I think that's nuts. You are literally counting on the market to compress cap rates in order for you to profit properly. That's the opposite of being careful. And we've seen how so many sponsors today are in trouble because they bought at a 5 cap and they assumed that cap rates were only going to go up to 5.5 when they sold in 5 years. And now those cap rates are at 6.25, sometimes even higher than that. And they're in trouble. And now to say, well, hey, I'm buying at a 6 cap, that's the market, and we're going to sell at a 5.5, that is crazy irresponsible. So be careful. Ask the sponsor, first of all, what the market cap rate is. Here's the key word is, what is the market cap rate? What are properties in that area that are stabilized selling for? Price per door is number one. And number two is, what cap rate are they selling for? And do you have data you can send me? Okay. Here's what I've seen sponsors do, and I'm not saying this sponsor, certain sponsors are doing it right now. I haven't seen a lot of slide decks lately, but what some sponsors have done in the past is, and this is a perfect example. This is a property we were looking in South Carolina for a while. Property in South Carolina, underwrote it. Market cap rate was like a 5.25, 5.5, somewhere around there. I can't quite recall. Anyways, we underwrote, exiting at a 5 and let's call it 3/4, 6. Okay. We ended up losing on the deal and we got crushed. Like, we were like 40% below what the person that bought it for. And then I found out the person that bought it, because they sent me their deal deck and as a, hey, invest in this deal. And I dug in and I looked at it, and they were saying, hey, we're buying this at a 4 cap and we're going to exit at a 4.5 cap. Well, that's the trick, is they said the cap rate in the market is a 4 cap. Well, that's not true. Just because you're buying it, which is because you're overpaying, doesn't mean the cap rate in the market is that amount. Okay. So watch, what are they buying it for, a 5 cap or 4 cap or whatever. But if the market is a 6 cap, they're overpaying for it, which might be okay, by the way. But when they go to say, we're going to sell it, you have to look at what the market's actually doing today. Okay. That's what you have to base it on. You go, either what the market is today, 50 basis points higher, 100 basis points higher, but first of all, you don't want to go lower, and you don't want to base it on what you're buying it on. So I'm sitting here going, this is going to exit at a 6. He's saying it's going to exit at a 4.5 because he bought it at a 4. Of course he could pay way more than me, because that makes a massive difference in your returns. And luckily he probably ended up doing okay, because that was about 5 years ago. And so if he sold it by now, that was probably like 6-7 years ago. So if he sold it, he did fine, because market cap rates did go down and he ended up looking like a genius on that deal. I should have bought it, quite frankly. The other thing that I see is IRR drives a lot of deals. And as an investor, be careful with IRR driving all of your profits. And I've got caught in this myself, is being too careless about cash flow and what's happening with that property on a cash flow basis, and only being focused on what's my IRR, what's my return in the end when I sell the property. So if you look at the deal, and it's very, very light on cash flow, and it's very heavy on IRR. What does that mean? It doesn't mean it's a bad deal. Okay. I'm not telling you it's a bad deal. It could be a great deal, and you might want to invest in this deal. Well, what you have to understand is that there's a lot of risk in that deal, because all of your profits, or nearly all of your profits, are based on future projections. And future projections are the hardest projections to actually hit. Okay. One thing I know for certain on my underwriting, on our underwriting, it will be wrong. We're hoping it's wrong in a good way, right? But it will be wrong. And so if you want high risk, and you're okay with that high risk, you love the area, you love the deal, you love the business plan, you believe in the sponsor, all that kind of stuff, go ahead and go forward with the deal. But just understand that if things don't work out, hey, it's on you because you took that higher amount of risk. If we've got current cash flow, that's, 6-7% to return to the investor, and that's where your starting point is, well, then we know we've got good cash flow. And if the upside doesn't happen, the downside, though, is very limited. So we've got high upside, or sorry, lower upside, but definitely low. And, maybe it's, well, I shouldn't say ever no, but very low downside. And we know, hey, things don't go right. It's a bummer, but we're going to make 10% on our money. Where this other deal, if things go wrong, we're going to make 0%, or, we're maybe even not going to get our capital back. But if things go right, hey, we could make a killing, right? So you just have to understand that. I think that's really important. How much is IRR driving the return versus the monthly cash flow that you're getting from that deal? Okay, so a couple other things. Fees. We recently got sent a deal from this group that was wanting us to raise money. They're charging a 4% acquisition fee. That's crazy. Okay. They're charging like a 2.5% asset management fee. Way too much. They've got disposition fees, meaning when they exit or refinance, they've got these big fees that they're going to take. Look, don't get just chopped apart by fees. This should be incentive-based business, meaning the sponsor is rewarded based on the profitability of the building, not based on fees. Fees eat into your profits. That means they get those fees regardless of what happens. So you might make 1% on your investment, but that sponsor made millions of dollars, and you and all the investors made $100. Like, whoop-de freaking do. But they made millions because they feed the crap out of you. Be careful. Okay, what else? Look, returns are another big thing. You get attracted by good returns. I get it. I'm a human too. Like, yeah, do I want a 10% return, or do I want a 25% return? Like, I want a 25% return. Of course, but be careful. Watch how much returns you get. Just because the pro forma deck says you're going to get great returns doesn't mean that you're going to get those good returns. So just think about the returns. Don't get too excited about them. It's easy to say, hey, great returns, that I want that deal. And maybe you do, but maybe you don't. So think about what they're truly offering, what the risk profile is, and what you're looking for. Do you like cash flow? Do you like high risk? Do you like high potential for returns? Again, the bigger the potential for big returns likely means the higher the risk. And it's easy to get juiced returns or show juiced returns on a pro forma just by changing a couple things. So we looked at a deal recently that somebody was offering. They had 3% rent growth and they had 2% expense growth. That's likely not going to happen in the real world. It could, but again, if that doesn't achieve that, you're going to get much less returns. They're saying, hey, we're going to exit at a 5 3/4 cap. Market is about a 6.5 cap. Like, look, if you exit a 6.5 cap, all of a sudden this 20 IRR deal, a couple of things go sideways, and this thing's at a 10% IRR, and maybe less. So just understand the returns and understand, are they realistic, or are they optimistic? Okay. One of the things we like to do is kind of set a range of returns and some expectations. We've done that more recently, is saying, look, We could see this 20 IRR, but we could also see this 12 IRR. So here's kind of where it looks like at different exits. This is where the market is. This is where we're assuming we're going to get, but here's kind of the range, and lots of different things can happen. I like to see some stress tests. So I want to make sure this sponsor has stress tested on numerous different things, different exit caps, different occupancy levels, different rent growth, different expense growth. What's my vacancy rate? Where's my break even vacancy? Where, where can things go wrong? What are my biggest risks on that deal? I want to see that type of stuff. Another thing I think is really important, this doesn't mean it's a bad deal, but understand who is raising the capital for that deal. Is it the direct GP, the direct general partner, sponsor, the one that's actually running and operating the deal? Are they using third party management, in-house management? What's their uh, relationship with that, and how long has it been going on? Or is it maybe a co-GP, somebody who isn't really in charge of making the decisions, but they're raising the capital for it? Maybe they have a little bit of um, say in how things go. Or is it a fund manager who doesn't have any say in how things go? So you might trust the fund manager, but do you trust the sponsor? Now, if you've got a good fund manager, that fund manager has done a ton of due diligence on the sponsor. The fund manager is investing their own funds in the sponsor. And if you've got a good fund manager, it can be a great way to access multiple deals, kind of tried, not necessarily tried and true deals, but maybe a tried and true sponsor. Like, this is a fund manager who's been investing them in a while. They've got experience and track record with them, and you're coming in the first time. You've never dealt with a sponsor before, but you go, hey, this fund manager has been with them, and they can speak to the track record. Okay, that can be okay. So, but it can also be big risk if that fund manager is the only one you're trusting, and that fund manager doesn't have that big of experience with this group. The fund manager is not going to have a say in things likely, and so understand who you're actually investing with. Is it the lead sponsor? Is it a co-sponsor? Is it a fund manager? And what kind of relationship, what kind of responsibilities do they have? And what kind of risk did they put forth? If they're not investing in the deal themselves, I wouldn't invest with a co-sponsor or a fund manager. Quite frankly, even the sponsor, I wouldn't invest unless they're putting money in the deal. So understand that. Look, there's a lot more things. Real quick, uh, is it short term? We can easily juice returns on a project if I say we're going to sell this in um, 2-3 years. It can look a lot better as far as IRR goes. But if I say we're going to hold it for 5, my IRR goes down. At 7, my IRR goes down. So sometimes it tricks you into thinking we're getting better returns. By the way, there's tax consequences. Every time you sell, you have to pay taxes. So it might look good on paper that you made this great return. You sold the building. Now you have to figure out, where am I going to put the money? I got to pay taxes on all that money that I just made. I got to figure out, how do I roll that over? And if I don't do it, I'm going to have this big bill. I got my money's just sitting there doing nothing. All right. I got to really do due diligence again. So sometimes you might be excited to sell a building. I think that a lot of the time it's actually not worth it to invest with a group that is flipping properties. And by flipping, I mean they're in and out in really less than 3 years. Um, I think a longer hold, 5 years, 7 years, 10 years is a better deal, especially if they can refinance and you can roll your money tax free. That's amazing. If they are flipping, again, that's higher risk. So understand that. But if they are flipping a property, 3 years less hold period, what are they doing? Are you confident they're going to find you another deal that you can invest in? Are they 1031 exchanging into the next deal? So those are big questions to ask if they've got a short time horizon. How can you avoid some taxes with that strategy? The next thing, look, how is your communication? I'm surprised a lot of sponsors only communicate once, 1 to 4 times a year. We communicate every single month. I just thought that was the norm. We provide financials every single month. I thought that was the norm. And I'm finding out that that's not even close to the norm. So a lot of sponsors are only communicating, you know, 1 to 4 times, 2 to 4 times typically a year. So is that okay with you? In my opinion, transparency is huge. I want somebody who's going to communicate with me. So lots more to talk about. I'll probably continue and talk about more things to look for, red flags to look for. By the way, this is good whether you're going to be passively investing in a deal, whether you're going to be actively investing in a deal. You got to think through a lot of these things. And if you're raising money for a deal, you got to be thinking about, how do I make sure I'm protecting my investors? It's easy to take the money. It's hard to actually do the work, right? So make sure that you are thinking through the steps, the processes, how you're protecting your investors' money, how you're communicating with your investors, what kind of questions are your investors asking, what are they looking for, and how do you talk to them about actually what you're doing and why it makes sense. Because I've got plenty of investors that invest with me. They also invest with other people. And why do they want to invest with you? What makes you stand apart? Why does it make sense versus going with the guy who's offering a 25 IRR, right? That's super attractive. Like I said, you might be only offering a 16 IRR. Why is your deal actually the better deal to get into? You have to know those types of answers. And as a passive investor, you need to understand why that 16 IRR deal might be better than a 25 IRR deal. Why might you want to invest in that deal? All right. That's it for today. I am signing out. Make every day a Saturday. Thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.